You've held gold. Almost everybody has. A wedding band. A chain your uncle wore that you were never allowed to touch. One of those little bars they sell at Costco now, which is still the funniest sentence in American retail. And at some point you looked up what it was worth, and the number was bigger than you expected, and a very specific thought crossed your mind. What if I owned the place it comes from? Not a coin, not an ETF. The whole, the actual dirt. I've spent about 12 years looking at businesses for a living, and a gold mine is still one of the strangest ones I've found. It is not a gold business. It's a spread business, a countdown clock, and a funeral you have to prepay. Stick with me, because by the end of this, you'll understand how a mine can print $2,000 of margin on every single ounce and still bankrupt the person who owns it. My grandmother had a ring, thin gold band, worn almost flat on one side from 50 years of her rubbing it with her thumb when she was thinking. When I was 11, I asked her where gold came from, and she said the ground, which was true and completely useless. So I looked it up, and I found a photo of an open pit mine in Nevada. This enormous terraced crater, like somebody had unscrewed a mountain. Haul trucks at the bottom that looked like ants. And the caption said the whole thing produced a few 100,000 ounces a year. I remember thinking, that's it? All of that? For that? Turns out 11-year-old me had accidentally found the most important number in the entire industry. Let's start with the number that makes everybody's eyes go wide. Gold right now is trading around $4,000 an ounce. It's been bouncing between $4,000 and $4,200 for months, up roughly 20% from a year ago. Historically big year. So what does it cost to produce an ounce? The industry uses a metric called all-in sustaining cost, AISC, and it's a decent number because it includes the boring stuff. Mining, processing, site admin, royalties, the capital you spend just to stay flat. The median producer sits around $1,500 to $1,700 an ounce. The best operators come in lower. The strugglers come in way higher. So do the arithmetic with me. 4,000 in, 1,600 out. That's a margin north of 60%. 60% on a commodity that you dig up with a shovel the size of a house. If I pitched you a business with 60% margins and a product that has never once gone to zero in 5,000 years, you'd ask me where to wire the money. So why isn't everybody who owns a gold mine rich? I got my first real answer from a guy named Tom Brandt at a mining conference in Denver about 6 years ago. 30 years in, hands like a catcher's mitt, extremely uninterested in anything I had to say about discounted cash flows. He pulled a rock out of his jacket pocket. Gray, unremarkable, about the size of a bar of soap. He says, "How much gold you think is in there?" I said I had no idea. Some? He said, "None you can see, and that's good ore." Gold mines don't measure their product in ounces per rock. They measure it in grams per ton. A solid open pit deposit in Nevada might run 1 gram per ton. Underground can be richer, 5, 8, 10 grams. But 1 gram per ton is a perfectly fine, financeable, real mine. 1 gram is roughly the weight of a paperclip. A ton of rock is roughly the weight of a small car. So the business is this. You blast, dig, haul, crush, grind, and chemically process a small car's worth of solid rock, and at the end you get a paperclip. Then you do it again, about 30 million times a year. That's the whole industry. Everything else is a footnote to that one ratio. And once you see it that way, the 60% margin stops looking like free money and starts looking like the reward for running one of the most brutal materials handling operations humans have ever built. There's a second number Tom mentioned, and it's the one that quietly kills mines: the strip ratio. The ore isn't sitting on the surface waiting for you. It's under worthless rock, waste. To reach 1 ton of ore, you might move 4, 6, sometimes 12 tons of waste first. You pay full price to move it. Diesel, tires, labor, explosives. You earn exactly 0 from it. So when a mining company says costs rose because of higher deferred stripping, what they're telling you is, We spent a fortune this quarter moving rock that contains nothing, so that next year we can reach the rock that contains a paperclip. And the strip ratio almost always gets worse over the life of a mine. Pits get deeper, walls get wider. The gold doesn't move, but the cost of reaching it climbs every year. Which brings us to the part nobody puts in the brochure. Before you produce a single ounce, you have to build the thing. And building a modern gold mine is one of the most capital-punishing projects in the private sector. A serious new mine costs somewhere between several hundred million and a couple $billion to build. And the timeline from "we found something interesting" to "we poured our first bar" runs, on average, 10 to 15 years. 10 to 15 years of spending, zero revenue. Drilling programs, geologists, metallurgical test work, a preliminary economic assessment, then a pre-feasibility study, then a full feasibility study, each costing millions, and each capable of telling you the answer is no. Water permits. Community agreements, roads, power lines, sometimes an entire town for your workforce. All of it before you know for certain the deposit even works. My friend Sophia Lindquist runs money at a resource fund, and she's the one who finally made mining valuation click for me. We were at a bar in Toronto during the big March conference, and I was complaining that miners get valued on a 5% discount rate when every other sector I cover uses 8, 10, 12. She put her drink down and said, "That's because you're not valuing a company. You're valuing a bond that pays in ounces and then dies." Then she said the thing I've repeated 100 times since. Everywhere else, terminal value is the whole argument. In mining, there is no terminal value. There's a hole and a bill. Think about how strange that is. Value a restaurant chain or a software company, and most of your model sits in the assumption that the thing exists forever. A mine has a defined life. 12 years, 18, 25 if you're blessed. And then it's over, and the asset isn't worth zero. It's worth negative. Because now you have to clean it up. That's the countdown clock. And it starts the day you turn the key. Which leads to the accounting quirk that trips up every investor who wanders in from tech. In a normal business, depreciation is kind of a fiction. Your building doesn't really lose value every year. The accountants just say it does. In mining, it's real, and it's measured in units of production. Every ounce you sell is an ounce that no longer exists in your reserve. You're liquidating the company one truckload at a time. So a gold miner has two jobs: dig the gold and sell it, and find more gold, so next year there's still something to dig. That second job is expensive, uncertain, and completely invisible in this quarter's earnings, which is exactly why management teams quietly underfund it. Easiest cost in the world to cut, and the consequences show up in 5 years, by which point that CEO is running somebody else's company. Reserve replacement ratio. Look it up on any miner you're considering. If they're consistently replacing less than 100% of what they mine, you don't own a growth company. You own a melting ice cube with a nice dividend. Okay, so the majors are hard. What about getting in early? This is where I have to tell you about Curtis. Curtis is a guy I've known since college. Works in medical devices, does well. In 2020, he calls me all excited about a junior exploration company in West Africa. Drill results looked great. Stock had tripled. He wanted in. I told him what I tell everybody about juniors. A junior explorer is not a business. It's a lottery ticket with a burn rate. No revenue, zero. And the entire operation is raise money, spend it on drilling, hope the drill hits, raise more money. Here's the part Curtis didn't internalize. Every raise happens by issuing new shares. Your slice gets smaller, not a little smaller, sometimes half. He put in $40,000. Over 3 years, that company did 4 financings, 2 of them below where he bought. Drill results kept being encouraging. They never got to a feasibility study. His position today is worth about $6,000. And the wild part is, the company still exists, and the gold's still down there. They just diluted him out of it while they looked for it. He wasn't wrong about the geology. He was probably right about the geology. He lost because he owned a shrinking fraction of a company that had to keep selling itself to survive. That's not bad luck. That's the business model. Now let me flip this, because I don't want you thinking mining is just a machine for destroying capital. When it works violently well. Look at that spread again. $4,000 gold, $1,600 costs, margin of $2,400 an ounce. Let gold rise 10%. 4,000 becomes 4,400. Your costs barely move because diesel and labor don't care what gold does. Margin goes from 2,400 to 2,800. A 16% jump in profit from a 10% move in the metal. Run it the other way. Gold drops to 3,000. Margin collapses to 1,400. Almost half your profit gone on a 25% price move. That's operating leverage, and it's why mining stocks swing harder than the metal. No derivative involved, just fixed costs meeting a floating price. It's also why the producer running at 1,800 an ounce is a completely different animal than the one at 1,200. Today, they both look like heroes. In a real downturn, one is a going concern, and the other is a press release. All right, let's get out of the boardroom, because I know some of you are thinking about the small version, the claim, the creek, the dream. I have a guy for this too. Del Ferris. Met him in a diner outside Winnemucca, Nevada in 2019, and he talked at me for 2 hours while my eggs got cold. Best 2 hours of the trip. Del has held placer claims on federal land for most of his adult life, and this part surprises people. You actually can do this. Under mining law older than most of the country's infrastructure, a U.S. citizen can stake a claim on open federal land. You file with the BLM and the county, you pay an annual maintenance fee per claim, and that's your claim. The fee runs in the low hundreds per claim per year, and it gets adjusted over time, so check the current schedule. But the point is, that's not the expensive part. Here's what Del told me, with no bitterness at all. I've made money most years, not a living, money. He runs a small sluice operation in the summer, recovers a few ounces a season. At today's prices, a few ounces is $12,000, $15,000. Then subtract fuel, equipment, wear, the truck, permits, water compliance, and 4 months of his life. He was straight with me. The claim isn't an investment. It's a hobby that occasionally pays for itself, and about 1 year in 7, it pays for a truck. Which honestly sounds better than most hobbies, but it isn't the economics of owning a gold mine. It's the economics of a very expensive fishing trip that sometimes hands you a paycheck. Now, the funeral. I met Elena Vargas at a permitting workshop. She does reclamation engineering, which means her whole job is figuring out what it costs to make a mine site stop being a mine site. Before you're allowed to dig, in most U.S. jurisdictions, you post financial assurance. A bond, a letter of credit, something real, sized to what the government estimates it would cost to clean up your site if you vanish tomorrow. For a large open pit that can run into the hundreds of millions. And Elena's point was that the estimate gets updated. Costs rise, regulations tighten, and your bond requirement in year 15 can be dramatically higher than what you modeled in year 1. That's a live liability most retail investors never look at. Then she said the line I wrote on a napkin and still have somewhere. Every mine is born with a death certificate. The only question is who pays for the burial. Because when it goes wrong, and it has gone wrong, the cleanup doesn't disappear. It changes hands. There are sites in Colorado and Montana where the operator went bankrupt and American taxpayers ended up carrying a bill in the hundreds of millions. The gold left, the bill stayed. So who actually makes reliable money in gold? Let me tell you about Hal Weaver, who I met at that same Toronto conference at a hotel bar, at an hour I'm not going to specify. Hal worked in royalties. When I asked what he did, he gave me the cleanest description of a business model I've ever heard. I don't own mines. I own ounces. Somebody else owns the mine. Here's the structure. A royalty company hands a miner cash up front, usually during construction, exactly when the miner desperately needs it. In exchange, it gets a permanent cut of everything that mine ever produces, sometimes a percentage of revenue off the top. Sometimes a streaming deal where they buy a fixed portion of the gold at a deeply discounted fixed price forever. Think about what that does to the risk profile. The miner's costs go up, doesn't matter. They get paid off revenue, not profit. Diesel triples, not their problem. The mine finds more gold and extends its life 8 years. They get all 8 years free. They already paid. A handful of employees, interests in dozens of mines, almost no operating cost, no labor risk, no reclamation liability. Hal put it like this: the miner is the farmer. I'm the guy who owns the land. Compare how the best royalty companies have done against the actual operators over the last 20 years, and it isn't particularly close, which is an uncomfortable lesson. The most reliable way to make money in gold mining has historically been to not do any mining. One more risk, and this one's been busy lately. You don't just own a mine. You own a mine somewhere, and somewhere has a government. When prices spike, something predictable happens. Governments look at enormous margins on a national resource and decide they should be getting more of it. Royalty rates rise, export duties appear. Tax terms get renegotiated on assets built under a completely different set of promises. You can see it in the filings right now. Several producers are reporting higher cost per ounce this year, specifically because royalty payments went up, and royalty payments went up because gold went up. Part of the windfall gets redirected before it ever reaches you. That's not corruption, that's just the deal. Build an immovable multi-billion-dollar asset inside somebody else's borders, and you've handed them leverage you can never take back. The mine can't relocate. That's the whole point of it. So let's put it together, because I told you at the start this thing was 3 businesses wearing one coat. It's a spread business. You sell at a price you don't set, you buy inputs at prices you don't set, and everything you earn lives in the gap. It's a countdown clock. Every ounce sold is an ounce gone, so the company has to keep rediscovering itself just to keep existing. And it's a funeral you prepay. The final value isn't zero, it's negative, and that liability grows while you sleep. Mark Twain supposedly said, "A mine is a hole in the ground with a liar standing next to it." Funny line, but I think it's slightly wrong. Most people in this industry aren't liars. They're optimists doing arithmetic on assets that punish optimism. The gold is real. It's just that the ground is very heavy. The clock is always running, and the price of everything is set by people who will never see your mine. If you want exposure to gold, you have options that don't involve moving a small car's worth of rock to get a paperclip. If you want exposure to gold mining, know that you're buying operating leverage, and leverage cuts both ways with equal enthusiasm. And if you actually want to own the whole, go find Adel Ferris. Buy him breakfast, let your eggs get cold. He'll tell you more in 2 hours than any prospectus will. If this was useful, subscribe, because I'm working through the economics of businesses people think they understand, and mostly don't. Next on the list is one you walk past every single day without ever wondering who owns it. And tell me in the comments which business I should take apart after that. I read all of them. Some of the best videos on this channel started as a one-line comment from somebody who knew the industry better than I did. See you in the next one.